Hi, I'm Hilary Hendershott. I'm the founder of Hendershott Wealth Management. We publish content to help you strengthen your financial life, grow your net worth, and feel supported through the moments that matter. If that's the kind of guidance you find yourself looking for, take a moment to like this video and subscribe. Today, I want to talk about a question that tends to show up whenever markets are near all-time highs. Shouldn't we be taking some chips off the table? When markets have had a strong run, and they have, it's natural to feel uneasy. Portfolio balances are higher. Headlines are mixed. Someone on television is predicting trouble, and the thought creeps in. We bought low. Now our accounts are high. Shouldn't we sell before it falls? This sounds responsible. It sounds disciplined. It even sounds prudent. But underneath that question is a deeper one. When someone says, should we be taking some chips off the table? What they're really asking is the market about to fall? And here's the honest answer. Nobody knows. Not the pundits, not the economists, not the market strategists, not me. Markets don't send advance warning notices. They don't ring bells at the top. And if your strategy depends on guessing correctly what happens next, you're no longer investing. Now you're speculating. It always feels smart to talk about selling before a decline. It also always feels smart to stay invested if the market continues rising. The problem is that you can't know which outcome is coming. History has shown that far more money has been lost preparing for corrections than in the corrections themselves. Trying to anticipate downturns often results in missing recoveries, and recoveries tend to happen faster than most people expect. Now, this doesn't mean never adjust. There are situations where trimming positions is absolutely appropriate. If your wealth is heavily concentrated in a single stock, if your goals have changed, if your time horizon has shifted, if you're taking on more risk than your plan calls for, that's not market timing. That's alignment. Thoughtful planning means your portfolio reflects your goals, your timeline, your cash flow needs, your risk capacity, not the latest headline. If your goals haven't changed and your time horizon hasn't changed, then your portfolio should already be structured to handle volatility, because volatility isn't a surprise feature of the markets. It's a built-in feature. Dare I say it's guaranteed. Smart planning means you don't need a quit while you're ahead button. You need a strategy that accounts for market cycles, downturns, recoveries, and the fact that nobody can predict the next move. If markets are high and you're feeling uneasy, that feeling is normal, but unease alone is not a strategy. The right question is not, what is the market about to do? The right next question is, has anything meaningful changed in my life or my goals? And if the answer is no, then staying aligned with your plan is often the most disciplined move available, because disciplined planning beats reacting to forecasts every time. If you're thinking about your next financial chapter and want a partner who looks at the full picture, not just your investments, we'd love to connect. We're a fee-only fiduciary team focused on after-tax outcomes and long-term planning, helping our clients keep more of what they earn so their money can support the life they're building. If that sounds like the kind of guidance you're looking for, you can schedule a complimentary conversation with one of my lead advisors by visiting hendershottwealth.com/contact to see if our approach is the right fit for you.